to the podcast, everybody. Thank you for joining me. It is in the middle of the trading day. We usually do them after the market closes, but frankly, this is the time of day right now that I can get it done right before lunch. Won't have time this afternoon, so I want to get something out to you. Got a lot of volatility in the stock market, and let's just jump right into it. We'll touch on oil, touch on gold, touch on the S&P, Dow Jones, all kinds of stuff. So here we go. All right, well, the S&P, you can see we're getting more volatility than I've seen in 2-3 years, and I think that this isn't going to end. And that doesn't necessarily mean it's a new bear market. That doesn't mean you should be selling all your stocks. But it does mean is that this market may be different than what we've seen in the last couple of years. You know, in the last couple of years, it's been all about the S&P 500 large cap U.S. stocks going up. And now in January, we saw the opposite, right? We saw the Dow Jones get hurt the worst. And you know, we started to see gold do well. We started to see some parts of international doing better than others, doing better in the U.S. maybe. So you start to mix it up, and of course we have a big bounce in oil. So things seem to be changing. Let's take a look at the S&P first. So we do have this volatility, and what I want to point out is that we're still in this uptrend that we've been in. We did have a pretty nasty break in October. Right in here, we broke the 200-day moving average, but it was a big head fake because it hadn't been below a long time, and everybody wanted to start selling at that point. And at that time, you know, we were talking about that it felt and looked more like a correction because of the steepness and how fast it was happening, and it kind of came out of nowhere. Now what I think you have is, to me, we're still in this uptrend, but I think these little volatility spikes that you're seeing here, where we're falling, we're rapidly going back up, falling. You know, you're getting. I mean, if you're trading, you're getting whipsawed. And if we take a look at the spiders, which is the same thing, but the ETF for it, it's a little easier to see here. But this is the pattern that I'm seeing. It's getting tighter and tighter and tighter. We're at the upper end of it right now. So if we can go above the highs from January 22nd, you know, start getting up here, then maybe you could say, okay, well, this lower highs pattern is breaking up. But we have continued to see lower highs and lower highs. So, again, if you're kind of wanting to day trade this, we've had 3 up days. Wouldn't surprise me to see things start to roll back over. Now, going back to the S&P 500, which, again, this is just the index as opposed to looking at the ETF. You know, it's hard to show you on here, but we are seeing more and more deterioration in the last few weeks. Really started in September. I think, you know, if the market starts to break down here, we're going to look back at this time frame right here and say, yeah, it broke the 200, came back into it, but this was the time that things started to deteriorate. You know, we started to see, if you take a look at junk bonds, you know, we started to see that breakdown in July, August. You know, we've obviously seen small caps. Take a look at small caps. They've been moving sideways, but haven't made new highs like maybe the S&P did. So they started to kind of lag in the last half of the 2014. So you're starting to see some of that. And the thing that concerns me, I think, most about this market is that there's less and less participation with the market. And what I mean by that is if you look at the number of stocks that are above their 200-day moving average, their 50-day moving average, it's declining. So from, you know, this point in mid-September until now, less and less stocks are near their highs. More and more stocks have fallen 20%. You know, on the Russell 2000, almost, I think it's about 45% of those stocks have already fallen 20% from their highs, which would be a technical bear market. So you're getting less participation, and I think what's happening now is I do feel like there is deterioration, and that can always reverse itself, but we can't ignore that. So I've been scaling back a little bit in some of our strategies, and again, most of them are on, you know, they're preset, so to speak, on a system, so that we don't have to say, well, I feel like selling or I feel like buying. And some of those have been telling us to scale back and lower the risk a little bit, especially after you have a couple of big days like we've had. But internally, they haven't been bad days. They've been strong days. But when you look at this pattern here and you see what the backdrop is right now, and everybody around the world is lowering interest rates, they are obviously trying to depreciate their currencies. We've seen Australia. We saw China do it just this week. They're injecting capital in there. All these things are happening. That's because global growth is slowing. So when you put all of that together, you can see why stocks are struggling. So again, it's much more choppy now than we've seen in quite a while, and the volatility is starting to pick up, and that could be a good thing for you. It means there's more opportunities to trade, but from an investment standpoint, it may mean that you have to maneuver, do some things differently in 2015 than you did in 2013 and even the first part of 2014. So let's take a look at oil here, and I'll bring up the USO because it shows you intraday. We're down about 4% on oil. Don't pay attention to this. This is the ETF price, not the oil price. So we obviously have this huge drop, and we've had a big run, about 20% from low to high in the last few days. I even saw somebody yesterday say, well, now we're in a bull market because it's risen 20%. That's the whole problem with saying something's down 20% or up 20%, saying it's in a bear bull market. It has to do with the duration. Oil is in a bear market, okay? It had a 20% jump off the bottom. It is in a bear market still. Will this ultimately be the bottom in oil? Maybe. I don't know for sure, but I can tell you that we're still in a bear market. and having a 20% jump off the bottom when something's fallen 60% is not a new bull market. So that was kind of a foolish comment on his part. This is as of yesterday, and I just wanted to show you the actual price of oil. Where can oil get during this bounce? And I'm not talking about going straight up. I'm saying, if this was a temporary bottom, where can oil get to? Well, this is when you start looking at retracements. We were at $110 a barrel roughly. We went down to $45 a barrel, 44 roughly. If you look at the high 60s, that is a place, mid-60s, that oil could bounce during this run. That would be a huge move and a huge profit potential. There's a lot of these stocks up 20, 30. There's stocks up 60% in the last 10 days because of oil turning around here. So watch that. But again, it could bounce to there, and I'm just looking at retracement levels. Ultimately, where does this go? I have no idea. I have no idea at all. Global demand continues to fall off. Oil is going to continue to fall and have a 3 handle in front of it. So, it's hard to say, but certainly this should not be surprising to many of you that have been watching markets for a long time. When you have something to this magnitude, you're going to have a massive short covering rally, and that's what we saw. And it may be over right now. I mean, we're down 4% today on oil. We gave back some of the gains yesterday in the middle of the day, but a little backing and filling. It wouldn't surprise me to see it pull back a little bit here and then start to move up a little higher. So let's watch that. Take a look at interest rates. They've had a couple of big moves up. And again, if global growth continues to fall, that would be a temporary move, and interest rates could start heading back down again. If we take a look at the VIX, the volatility index, this is what I'm talking about. These spikes are coming closer together than they have in the past. So we had a big spike in October, then we have one in December, we have one in January, February. I mean, we're getting these spikes closer and closer together. So in the big picture, something may be changing here, and we need to pay attention to that. So again, have your systems in place because this may be a different market. This market that, international doesn't go up, gold doesn't go up, commodities don't go up, and it's just the S&P. I don't think that's going to last forever. Speaking of gold, let's take a look at the GLD. GLD here is really doing the same thing it did last January. If you remember, right out of the gate in January of 14, look what happened here. GLD went from 115 to 130. Nice little move there. But it was contained within this down market, sideways market, whatever you want to call it. We're getting kind of the same move now. So gold could turn around. I don't see a real reason for gold to turn around other than, maybe it's time. Other than that, I mean, it's been moving sideways for such a long time, once it went up. But I still think ultimately gold can break down and go back down to under $1,000 an ounce. And then perhaps you would see a move after that. But we don't know. We don't know what's driving it right now. Bottom line is a lot of people thought it would be much higher given all the debasing of currencies around the world, and it's not. It's still sitting down here. So not doing anything with gold right now. I will say from a momentum standpoint, it is something that we're watching because relative to other areas, relative to stocks, relative to energy stocks and domestic stocks and international stocks and financials and things like that, gold is moving its way up the ranks. And so watch for that over the next couple of months. It could be something we put on for a trade, but we're not making a line in the sand saying, hey, this thing's a buy long term. Go buy some, because I don't think that's here just yet. Now I want to point something out to you guys. If this is the beginnings of a bear market, let's just say if, and we are, there's no question that I think we're in the early innings of the market deteriorating. But here's the thing, that can mean very different things. In the last 15 years, we've seen two bear markets. One was a 50% drop, and the other one was about 50%. The first one was very different than the second one. The 2000 drop was much more about the dot-com bubble. Those stocks fell dramatically, but there was plenty of places to hide. REITs did well. Healthcare stocks did well. There's places to make money. Small caps did well. So people in 2000 through 2003, there were places to make money. It was mainly technology that got hit the hardest. Fast forward to 2008, very little place to hide, right? That's why you saw the hedge funds do very poor during that time, and the only place to hide was treasuries or cash. So we have two very different bear markets. Who's to say going forward it's not very different? Who's to say that we don't have a market that instead of dropping 50% this time, what if it drops 20 and moves sideways for 5 years? Are you prepared for that? Are you prepared for what if energy stays weak but telecom starts doing very well? Are you prepared for utilities to start going down and biotech to start going down, but maybe technology does not? These are all scenarios that we don't know how it's going to play out, but I'm pretty sure that the next bear market or big correction will look very different than the last ones, because we're not a lot of people are prepared for that, and it's very easy to look back and want to assume that the next bear market looks just like the last two, and I have a feeling it's not going to be that way. So we could just be in for some more choppiness here, but we are on record as saying we see deterioration in this stock market, and so we need to pay attention to that. And I will warn you, though, that doesn't prevent the S&P or the Dow from making new highs. In fact, that's what we saw in 07. Many of you have been listening since 07, and we were talking about at that point, I was saying, hey, this market, something's wrong with it, and yet the Dow was making new highs. And everybody said, what are you talking about? The Dow's making new highs. And I said, the Dow's 30 companies. Underneath the surface, many companies are not experiencing that new high. They're experiencing 20% sell-offs. That's kind of what we're starting to see now. So be careful out there. It's not to say abandon all your stocks, but just be careful, because I think it's going to be a little more difficult to make money going forward. And there is going to be some opportunities to make money as well. But if we do break out of this kind of choppy sideways pattern to the upside, obviously we're very close to highs. It wouldn't be that big of a shock to make new highs. But if we don't see the internals catch up to that, we will go more on the defensive. We will start saying, hey, there is a divergence building, and we're actually going to build more cash and start shorting things as we go up, because this divergence isn't settling itself. And so far, that's what we've seen in the last couple of months here, and it wouldn't surprise us to see that continue. So I'm just telling you what I see, and hopefully that would change if you're on the long side of things. But certainly we are seeing deterioration in the markets, and don't let a couple of days fool you. I mean, we're getting these jerky days where you have 4 or 5 up days in a row and 2 or 3 down days, and it's just a very volatile sessions, and that can make it very difficult to trade. So keep the trading either very short or stay on top of it, because you can get whipsawed really easy. Still seeing a lot of people buy things and then immediately get stopped out of them, only to see that particular stock bounce right back, and you're completely on the wrong side of the trade every day for doing that. So continue to watch this. We need to see this thing resolve itself to the upside, and we need to see the internals begin to improve. We need to see junk bonds improve. We need to see treasuries start to sell off. We need to see money moving back into commodities and emerging markets. And we need to see more stocks participating in this rally. If we see all of that, then the health of this market is better, and we can say, hey, Mr. Patient, you are ready to check out of the hospital. But not seeing that just yet. All right. Let me know if you got any questions. You can see on the screen there. eggerscapital.com. You can email me at Karl@eggerscapital.com. We're on Twitter, Facebook, Google+, all of that. So take care. Have a wonderful rest of your day.